And if that name sounds familiar, just think of Dodd-Frank. Dodd-Frank, 2010, a voluminous legislation of 1,000 pages. I've met Barney. I'm acquainted with Christou very well. It was intended to resolve all the issues of the 2008 to 2009 financial crisis, etc. here. The architect of the bailout legislation is on the board of the bank, and his bank faces closure. Well, what's the deal with that? Well, they had invested in government bonds, and when interest rates rose from the 10-year Treasury note yield, going up from approximately 1 3/4 to 4, all those bonds depreciated by 80% in value. That's the outcome of long-duration bonds. Bond mathematics is straightforward. Rates up, prices down, and vice versa. While the rates climbed, the bond prices declined. As a result, they found themselves in financial trouble and insolvent, leading to their closure. Consequently, Barney Frank is out lamenting. The next day he remarks, "Well, yeah, but that's applicable to every bank in the country. There isn't a single bank that didn't accumulate treasury bonds at 1 3/4. They're all in dire straits, all insolvent. Moreover, the Fed made an announcement. They always have these 4-letter initials. I don't recall when the specific one was or whatever, but essentially, they stated that if you're a member bank and you hold treasury securities whose market value is below par, you pay $10 million. But they're only worth $8 million, a widespread situation across the board. So, if I had trillions of bonds falling under that category, I could deliver them, and they'd lend me the face value for a year. Thus, you're pledging collateral, yet receiving a loan of 100 cents on the dollar. I said, I have a 15-year-old car. Will you lend me what I paid for it? Because it was considerably higher than its current value. Yet, that's what they did. Consequently, while I grasp all these details, I'm pondering, so you've essentially secured every deposit in the banking system without any limitations. You've also insured every treasury bond at face value without limitation. What remains? What other options do you have? Because there's nothing else you can employ. Referring back to 2008, they secured every money market fund across the nation. Yet, Barney Frank complaining, yes, his bank was in trouble, but so were all the banks across the country. Why penalize him while letting the others off the hook? Well, the explanation is that Signature Bank was another crypto bank. It operated a gateway called Signet, which was a passage to the crypto world. That's why it was shut down. Note that they closed down 2 crypto banks. So now it's Monday morning. Where do we stand? The 13th. Everyone's inquiring about Janet Yellen. I'll say, hold on. What just occurred? You've guaranteed every deposit in the banking system. And she responds, well, not exactly. Only if you're systemically vital. And you're left wondering, all right, could you kindly define what's systemically important so we're aware? Because people are withdrawing from banks not covered. The reality is, you can't because the system is profoundly interconnected. This is why they mention financial contagion. It's metaphorical, but the mathematical dynamics mirror those of a viral spread. We've recently experienced a pandemic. However, this has held true as long as it's been studied. Mathematics of financial contagion closely resemble those of viral contagion. The equations, the way it spreads, they're familiar. Of course, Janet Yellen can't define what's systemically important. Firstly, they attempt, but it eludes them. Secondly, regardless of how small a bank is, if there's a run, the guy across the street will withdraw funds from that bank. And again, it's akin to COVID. It continues until the system collapses, meaning, by its dynamics, there's no such thing as a bank that isn't systemically important because they're all interconnected. Even the smaller banks borrow from the larger ones, etc. So Janet Yellen hesitated and didn't offer a satisfactory answer. She never does. She's not particularly astute. That's where we stand. The Fed has assured every bond at face value, even if it's worth 20% less. The FDIC has guaranteed every deposit. And Janet Yellen can't provide a clear delineation of what's included and what isn't. All right, now, a week passes. What's in store for the upcoming weekend? Once again, a Friday night press release, a forced merger, Credit Suisse and UBS. Now we're dealing with the major players. These are 2 of the oldest and most substantial banks globally. I believe Credit Suisse has been in existence since the 1870s, perhaps. I'm not entirely certain about UBS, but they were the top 2 banks in Switzerland. Credit Suisse fails, and UBS takes over. All right, and now everyone's asking, who's next? And there's a list. I'll go through it shortly. What considerations should we take into account? How can I assess whether a bank is likely to fail, irrespective of whether they're being bailed out? There are 2 excellent metrics. Firstly, Examine the ratio of uninsured deposits to total deposits. If that figure exceeds 30%, you're in a vulnerable position. In Silicon Valley's instance, it was 97% uninsured. Therefore, a small local bank holding, let's say 30% uninsured and 70% insured, is unlikely to have issues. Most of those customers would feel secure. They'd assume they're covered. However, when you're over 30%, especially 50, 70, 80, or 90%, you're a disaster waiting to happen. Secondly, total assets. There truly are too big to fail banks. It doesn't mean they're immune to failure, but it signifies they're virtually guaranteed to be bailed out, and that list is well recognized. Who's too big to fail? You can deposit money in these banks, they can mess up tremendously, and you won't suffer as a depositor. JP Morgan Chase, Wells Fargo. The usual suspects: Goldman Sachs, US Bancorp, Capital One, TD State Street, Citi B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. BMO Harris. These are the titans. Okay, I'm not implying they can't fail. I'm saying there'll be a safety net underneath them, and no one will lose anything. Perhaps stockholders might, but not bondholders, not depositors. But then there's another category, those larger than the local savings banks but not too big to fail. They're not part of the list of giants. These banks possess assets ranging from approximately 100 billion to 400 billion. As you inch closer to $1 trillion in assets, you're in the major leagues. However, between 100 billion and 400 billion, you're not too big to fail, yet you're significant enough to bring down the system if you stumble.